Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
China, as you know, has been complaining a lot about the dollar, and the question is, why are they complaining about the dollar now? And the subtitle here is, they love the dollar in the midst of the plunge. This is the dollar right here. This is the U.S. dollar index, and the bear market, I guess you could say, started here or in here in a little trace. But we'll mark here as the beginning of the bear market in the U.S. dollar, and I've titled this area the symbiotic zone. I also could have titled this area the implicit weak dollar policy, because it behooved the U.S. to have a falling dollar in here. It behooved China in a very, very big way to have a falling dollar here. You didn't hear China talking about a new world reserve currency in the midst of this. And of course, the dollar has appreciated, and their treasury bonds have appreciated, so their investment in their treasuries and their dollar holdings have appreciated since then, and now all of a sudden they're screaming, we need a new dollar reserve currency. Well, the reason for that is they're no longer gaining the benefit of the U.S. consumption. So they're now, since they're not gaining the benefit of the export demand coming from the U.S., they're stuck only with paper. So if they're stuck only with paper, then all of a sudden this idea of the dollar valuation starts to become more important than it did when they were blowing and going and shipping everything to the U.S., is what was happening here. Part of this, I think, is jawboning. They're trying to get the U.S. administration, and it's working in a very, very big way, to crank up the game of the symbiotic relationship by trying to be the stimulus or the stimulator of the world. I refer to the U.S. now as the global stimulator of last resort. That's what we're seeing out of the U.S. And I think part of this jawboning from China is pushing that. And let me show you what that symbiotic relationship looks like. This has really been this is the driver of this whole weak dollar policy area here, when this symbiotic relationship started in a very powerful way. At the middle was credit expansion. We had interest rates very, very low in 2001 because we were afraid of global deflation. The Fed pushed interest rates down. All those global derivatives were created, so we had a massive amount of credit. So that was part of the driver here. China became the global manufacturer, shipping low-priced goods to the U.S. consumer, which is their primary demand base, the largest there is. The U.S. consumer shipped back dollars, increasingly depreciated dollars, for increasing quality goods coming from China. So it, in effect, was a good deal for the American consumer. China took those dollars and all of a sudden became a global supplier of capital, in the sense that it recycled those dollars back into the U.S. Treasury market. It did that, again, not necessarily for any love for the U.S. Treasury market at the time, but they understood that in order to keep their currency suppressed, they had to buy dollars. And this game of recycling back in the Treasury market created more ample credit in the U.S., keeping U.S. interest rates low, which basically subsidized the American consumer and made him feel good. As we know, in the midst of that cycle from 2001 to 2007, before the credit crunch, U.S. savings rates went to negative 2%. They had the wealth effect of the stock market, wealth effect of the real estate. They were buying these goods cheaper and cheaper from China with a cheapening dollar, and interest rates were staying low. It was a great game. So sure enough, subsidizes the American consumer, who demands more Chinese products, which spurs more demand for Chinese investment and more demand from platform companies to drive investment into China to become part of this manufacturing base. And it was a nice symbiotic relationship and went on for years. Where did the game change? The game changed right here because of the credit crunch. No longer were we seeing credit expansion. We saw U.S. consumer wealth fading. So as consumer wealth fades, the U.S. consumer demands less. China's still shipping low-priced goods, but not as many. They're shipping a lot of these low-priced goods now to Asia, forcing them on some of their Asian trading partners, because the U.S. isn't buying as much, nor is Europe. So they're not getting dollars because the U.S. consumer is saving. And we think the U.S. savings rate is going to spike up to 10% of GDP. Sounds odd, but we think it will. That takes a lot of demand out of the market in a very, very big way for China. So China now is not receiving as much surplus. It's not recycling as much as they did back in the treasuries. They're holding treasuries at the moment because they really have no place else to go with that money. But they're not buying it as they were before because they don't have the need for the sterilization. They don't have the need to buy as many treasuries at the moment because the money coming in is a little bit less. So at the time, before the credit crunch, it was seemingly costless capital for the Chinese companies in China, created a lot of bubbles, a lot of money locked up inside the system in, as we talked about before, real estate from hot money coming in the stock market. All right, so it was and that's still the case. But now the Chinese government, and I'll show you in the next chart, has become the driver of this for China. I know this is very esoteric, and hopefully you can take this on your own time and take a look at it, this chart. This is what I showed in my presentation in Beijing, which led to total silence and not one question. I don't know if it was confusing or they just didn't want to, probably a little bit of both. But here's an important point about the Chinese economy and why we're seeing a lot of growth now from the stimulus in China. Capital investment is about 45% of GDP. That's very, very high. When capital investment, when they make an investment in capital infrastructure, it really is a big driver of GDP, more so than it is for other countries. And that's why the stimulus has been bumping up GDP. Okay, let's move on and see where we are now. And see what's happened in the midst of this credit crunch in terms of the relationship with the U.S. on the current account deficit. This is a current account deficit in the U.S. on a quarterly basis. And at the worst of this, during the free money stage, which we had an implicit weak dollar policy, and all that money was going offshore to fund a lot of global asset markets. Right around in here, we had a negative 2% saving rates in the U.S. This was the weak dollar policy. Consumption was huge. There's that negative 2%. You're consuming a whole lot of stuff. So that symbiotic relationship we just thought is just cranking. We have basically free credit, which was the driver of this. Now the credit crunch changes the game. It scares consumers, it drives leverage off the table, and now the consumer is saving. The U.S. current account is improving dramatically. And this improvement feeds directly into pain for China. When the U.S. doesn't buy, they don't export to the U.S. It's really that simple. And one of the questions we ask is, if the U.S. still isn't buying, how can China carry us out of this global recession? China does not have the demand internally. Brazil, Russia, or India, they don't have the internal demand to carry the globe. That stuff comes from Europe. It comes from the U.S., the two biggest consumer areas. And Japan, as we forget, is a very large economy in the doldrums. So we don't think it makes any sense to believe that China, given their high infrastructure and capital investment capacity and very, very low penetration from a domestic demand source, especially because of the fact that they have capital controls. So even if they demanded the products internally, they couldn't get to them. So that to us says there's something really out of whack in the world.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.